Imagine this. You hear about a stock that has doubled in just 1 year. Your friend tells you it is the next big thing. You feel the urge to jump in right away. But here's the real question. How do you know if that stock will keep growing or if it is about to crash? That is exactly what we are uncovering today. By the end of this video, you will know step by step how to research growth stocks like a pro, even if you are a complete beginner. And I will share one powerful filter that experienced investors use, but beginners almost always miss. Stay tuned because that one step can save you from losing thousands of dollars. Number 1. What are growth stocks really? Growth stocks are companies that are expected to grow faster than the average business in the market. These are not your slow, steady dividend-paying companies. They are the ones reinvesting profits back into the business to expand quickly. Think about companies like Amazon in its early days. Amazon was not paying dividends. It was building warehouses, creating new services, and scaling like crazy. Growth stocks tend to have higher price-to-earnings ratios because investors expect big future profits. For example, Tesla was a growth stock for years before turning profitable. Investors bought in not because of what it was earning today, but because of what it might earn tomorrow. Understanding this mindset is the foundation before you dive into research. Number 2, start with the story behind the company. Every growth stock has a story. What problem is it solving? Why is it different from competitors? And how big could this company become if it succeeds? Take Netflix as an example. Its story was simple but powerful. People hated late fees from Blockbuster. Netflix solved that with DVDs by mail, then streaming. Investors saw the potential for a whole new way of watching TV. When researching a stock, read about its mission, its products, and its market. Ask yourself, is this a company with a future vision that excites people? If the story makes sense, you move to the numbers. Number 3, look at revenue growth. The first number you want to check is revenue. Is the company actually growing sales year after year? A true growth stock will show consistent revenue increases, often 15% or more annually. For example, Shopify grew its revenue from about $200 million in 2015 to over $4 billion in less than 7 years. That type of revenue growth was a clear sign it was a growth company. If a company's revenue is flat or declining, no matter how good the story sounds, it is not a true growth stock. Number 4, check profit margins. Some growth companies are not profitable yet, but you should still look at margins. Gross margin shows how much money the company keeps after making its product or service. A software company, like Adobe, has gross margins over 80%. A grocery store might have margins closer to 5%. High margins give growth companies room to reinvest in marketing, research, and expansion. If margins are shrinking year after year, it could be a red flag that competition is heating up. Number 5, understand the competitive advantage. What makes this company stronger than others in its industry? This is sometimes called a moat. It could be a brand, technology, patents, or even customer loyalty. Think of Apple. People do not just buy iPhones. They buy into an entire ecosystem of products and services. That brand loyalty makes it much harder for competitors to take customers away. When you research, ask, can someone else copy this easily? Or does this company have a strong advantage that is tough to beat? Number 6, analyze the total addressable market. Even the best company cannot grow if the market is too small. That is why you need to check the size of the industry it operates in. For example, electric vehicles are projected to be a multi-trillion-dollar industry in the coming decades. That gives Tesla and other EV makers room to keep expanding. Compare that to a company selling beepers in the 1990s. That market was shrinking fast. Look for companies in industries that are not just big, but also growing. Number 7, check the balance sheet. Growth is exciting, but you do not want a company drowning in debt. A strong balance sheet means it has enough cash to keep expanding without borrowing too much. For example, during the pandemic, many travel companies with heavy debt struggled to survive, while companies with strong cash reserves stayed afloat. When you research, look at total debt compared to equity. If debt is piling up faster than revenue, be cautious. Number 8, management matters. Even a great product can fail with poor leadership. Look at the people running the company. What is their track record? Have they built successful companies before? Are they trusted by investors? Think about Elon Musk. Love him or hate him. His vision and ability to build companies like PayPal, Tesla, and SpaceX gave investors confidence. If management has a history of scandals or broken promises, that is a red flag. Number 9. Understand valuation. Here is where beginners often get trapped. A company can be amazing, but if the stock price is way too high, you might lose money. One common metric is the price-to-earnings ratio. Growth stocks often have higher ratios than the market average, but you should compare it to other companies in the same industry. For example, if two software companies both have strong growth, but one has a price-to-earnings ratio twice as high as the other, you need to ask if that premium is worth it. Number 10. Watch insider ownership and institutional support. If the company's leaders own a lot of shares, that is usually a good sign. It means they believe in the business and have skin in the game. Also check if big institutions, like Vanguard or BlackRock, are investing. They have teams of analysts digging into these companies. Their presence can signal confidence. But if insiders are constantly selling their shares, that could be a red flag. Number 11. Look for consistent innovation. Growth companies must keep innovating. If they stop, competitors catch up. For example, Amazon kept finding new ways to grow beyond online retail. It built Amazon Web Services, now one of the most profitable parts of its business. Ask yourself, is this company introducing new products, expanding into new markets, or improving its technology? Innovation keeps the growth story alive. Number 12. Compare with competitors. Never look at a company in isolation. Compare it to its peers. If you are researching a streaming company like Disney+, compare it to Netflix, HBO Max, and others. Ask questions like, who has more subscribers? Who is growing faster? Who spends more on content? This comparison will give you a clearer picture of whether your company really stands out. Number 13. Pay attention to risks. Every company has risks. It could be government regulation, competition, or changing consumer behavior. For example, Facebook faced risk when Apple changed privacy rules, making it harder to track users for ads. That change hit Facebook's revenue hard. When you research, list out the main risks and ask, if this risk happens, can the company survive and still grow? Number 14. Use financial tools and resources. You do not need to be a Wall Street analyst to do this. Websites like Yahoo Finance, Morningstar, and Seeking Alpha provide free data. You can see revenue, profit, debt, and even analyst opinions. There are also stock screeners that let you filter for companies with high revenue growth, strong margins, or low debt. Think of these as shortcuts to finding good candidates. The key is to use these tools, but not to blindly follow them. Always do your own homework. Number 15. Spot red flags early. Sometimes a company looks exciting but shows warning signs. Watch for things like slowing revenue growth, heavy debt, or frequent share dilution. For example, some small tech companies raise money by constantly issuing new shares that can hurt existing investors by making each share worth less. If you spot these red flags early, you can avoid painful losses. Number 16. The filter that beginners miss. Here is the powerful step I mentioned earlier. It is checking free cash flow. Revenue and profits can be manipulated with accounting tricks, but cash flow shows the actual money coming in and out of the business. If a company has strong and growing free cash flow, it means it has real money to expand, pay off debt, or reinvest. Companies like Microsoft generate billions in free cash flow every year, which gives them flexibility and stability. This one metric can separate hype from reality. It is like checking the fuel gauge before driving a car. Without cash, the company cannot keep running. Number 17. Look at customer growth. For many growth companies, customer numbers are just as important as revenue. If the customer base is expanding fast, it shows the business is gaining traction. Think about Spotify. Even before profits, investors tracked how many new subscribers it added each quarter. Consistent customer growth told the story of rising demand. If customers are dropping off, that is a danger sign no matter how good the product seems. Number 18. Study the company's pricing power. A true growth company can raise prices without losing too many customers. That shows strong demand and customer loyalty. For example, Netflix has raised subscription prices multiple times over the years. Even though some people complained, most subscribers stayed because the value outweighed the cost. If a company always has to discount products just to keep sales up, its growth may not be sustainable. Number 19. Keep an eye on global expansion. Many growth companies start in one country and then scale worldwide. This can be a major driver of growth. For instance, Starbucks did not stop with USA coffee drinkers. It expanded to China, Europe, and other regions, multiplying its potential. If a company has a clear path to international growth, that is often a big plus. Number 20. Check recurring revenue. Businesses with recurring revenue are much easier to predict. Think subscriptions, memberships, or long-term contracts. Adobe switched from selling one-time software to offering monthly subscriptions. That steady income stream made its growth far more reliable. A company with recurring revenue does not have to start from zero every month, which gives it stability and power to keep expanding. Number 21. Review research and development spending. Innovation costs money. If a company invests heavily in research and development, it shows commitment to staying ahead. Amazon poured billions into developing new technology, logistics systems, and AWS cloud computing. Those investments paid off massively. When you research, check how much of revenue goes into research and development. Too little might mean the company is not preparing for the future. Number 22. Watch for network effects. A network effect happens when a product becomes more valuable as more people use it. Think of Facebook. The more users joined, the more useful the platform became, making it harder for competitors to catch up. If a company benefits from network effects, its growth can accelerate rapidly. Number 23. Look at partnerships and acquisitions. Some companies grow faster by teaming up with others or buying smaller businesses. For example, Google expanded quickly by acquiring YouTube, which became one of its biggest revenue drivers. Partnerships can open new markets, while acquisitions can add new products or technology. Both can fuel growth beyond what the company could achieve alone. Number 24. Evaluate supply chain strength. If a company cannot deliver its products, growth will stall. That is why supply chain management is so critical. Apple, for example, has built one of the most efficient supply chains in the world, which helps it deliver millions of iPhones on time. When researching, ask, can this company actually scale production if demand surges? Number 25. Track employee growth and culture. People build companies, not just products. If a business is hiring top talent and employees are happy, it often leads to faster growth. Glassdoor ratings, employee turnover, and leadership culture can tell you a lot about what is happening inside. A company with toxic culture or constant layoffs may struggle to innovate and expand. Number 26. Consider technology adoption. Cycles. Some products grow fast because they ride a wave of new technology adoption. For example, when smartphones exploded in popularity, companies building apps grew rapidly alongside them. If a company's growth depends on a trend that is just beginning, it might have years of expansion ahead. But if that trend is already mature, the growth window could be closing. Number 27. Look at brand strength. Strong brands can charge higher prices, attract loyal customers, and expand faster. Nike is not just selling shoes. It is selling status, lifestyle, and trust. That brand strength supports its long-term growth. When evaluating, ask, do customers buy because they love the brand or just because it is cheap? Now, you know the step-by-step process of researching growth stocks. It is not about guessing or chasing hype. It is about looking at the story, the numbers, the risks, and the cash flow to see the full picture. So here is the question for you. If you had to pick just one growth company to research right now, which one would it be and why?